You want to get started? Cool. Thank you, Jackie. Okay, happy Friday, everyone. Welcome to the fourth installment of the Greentown Labs Investor Speakers Series. This week, we have an amazing panel put together on early stage investment. I will not be moderating the panel this week, but we do have the good fortune of having Juliana Greiser here to lead us in this discussion on early stage investments. I'm going to turn it over to Juliana real quick, but before I do, I just want to mention that we will be recording today's session for circulation within our community. So I do want to make sure everyone is aware of that before we get started. And please note that although we do have a little bit of a plan for the session today, we want to make this as interactive as possible. So if anyone does have questions, feel free to drop those in the chat and we'll do our best to work them into the discussion. Please do keep in mind with so many good questions, we might not be able to get to everyone, but we are more than happy to follow up with you after today's session to make sure you can get those questions answered. So Juliana, do you want to take it away?
Sure. Thanks, Andrew. First of all, I wanted to thank the whole Greentown Labs team for having me as a moderator. This is a great, stellar panel, so I'm really honored to be here. I'm Juliana Greiser. I'm a board member of the Angel Capital Association, which is the umbrella association for all the angel groups in North America, so including Mexico and Canada. And I think in terms of individual angels that belong to the ACA, we have around 17,000. So it's a great organization to be a part of. I'm also the president of the Business Angel Minority Association, and I'm also a lead investor in portfolio funds that are mainly activating women into investing. So with that, we're gonna get to some introductions from our panelists. So I'm gonna go in the order that I see the pictures here. Feel free to just talk a little bit about yourselves. I know that many of you have a lot of different hats, and I think it's important for everybody out here to know how much you do for the community in terms of the whole innovation community at large. So if you have several hats, please let us know that you're doing more than one thing. So Deb, I know that you're one of those, so why don't you go first?
Okay, hi everybody. Nice to see everybody virtually this Friday afternoon. So I'm Deb Kemper. I'm a general partner with Golden Seeds Ventures, which is a venture arm of Golden Seeds Angel Group. So Golden Seeds Angel Group is a 15-year-old angel group with over 300 members nationally. We invest in cross sectors, but we do have a gender lens. So we invest in companies with gender diverse founding teams and with female founders with the appropriate amount of equity. Prior to being the general partner of the newest fund for Golden Seeds, I did run the Boston chapter of Golden Seeds. I'm an active angel investor, you know, a slew of active angel investments. And I was also a member and still am of Clean Energy Venture Group, which I know I've done things at Greentown Labs in the past through Clean Energy Venture Group. So that's kind of my background.
Thanks, Deb. Chris, you're next.
All right. Welcome, everybody. I'm excited to be here. My name is Christopher Mirabile. I run Launchpad Venture Group, which is a network-based VC here in the Boston area, a large and active one, focusing primarily on science and technology oriented companies. And I also have served for many years on the Angel Capital Association, including being the chair emeritus of that organization. And I keep myself humble by being a software founder as well. Enterprise software is my background, but a partner and I started a little SaaS company, and that's been a terrific learning experience. And the final thing I'll add is that I am celebrating this year my 10th anniversary as a net zero energy person. So a little bit of a hiccup because we had some major squirrel damage on our solar array, but we've gotten that sorted out and we're back up to full production.
Chris, that's amazing. Congratulations. It's great to know. And I have to tell everybody that I'm an active user of Seraph's software that you put together, and I used and I installed for the Texas Medical Center Venture Fund, and we couldn't be happier. So you're too humble. Your software is really great, and it helps a lot of investors out there. Ziad,
excellent.
You're next.
Thank you very much. First of all, sorry, I have to have a still picture of myself. I look much uglier than in the picture. I am in Vermont, way up in Vermont near Canada, so our internet is very difficult. So I am the president and CEO of Boston Harbor Angels, another angel group in Boston. Really enjoy it. Have been doing it I've been an angel investor for almost 8 years now, and with Boston Harbor Angels, and I've been running Boston Harbor for close to 5 years. I also have, I'm the managing partner of a small angel fund called EQX, and now we're just launching EQX2, and EQ stands for Emotional Quotient, and that's my side passion. It's everything that has to do with emotional intelligence, and my obsession is with the jockey, not the horse. So oftentimes I spend a lot of time on founders, and if you ask me what does their business do, I wouldn't be able to tell you. And then other things I do for fun, I have a podcast with Faz that Juliana reminded me yesterday to advertise. It's called the Zid and Fizz. It's called the Zid and Fizz Show. He's on the West Coast, San Francisco. I'm in Boston, and we just talk about everything and nothing about angel investing on a weekly basis, except for the past 2 weeks because I had to relocate. Anyway, and also my other passion, where I really have the most fun is with mentoring. I think that mentoring is one of the most difficult thing, but yet the most rewarding when you help someone and then you see them evolve and avoid wasting time. That's the most amazing feeling. And then they come back and say, I closed the round, or I was successful at this, successful at that. So, and I love entrepreneurship. That is what it's all about. And now looking forward to talk today about everything entrepreneurship during these crazy, crazy times.
So Ziad asked me during the preparation call if he could crack some jokes, and I said that they are recommended and more than welcome.
Yeah.
So we need to keep it light. I can see that Andrew has already posted the podcast for Fizz and Zid, or Zid and Fizz, right? And I really recommend that. And so we're going to start with the questions. And I think because of most of the investor speaker series that Greentown Labs have had were towards the venture space, I wanted to start this questionnaire with a few key differences that you see between being an angel and being a VC. And I know that many of you have both hats because you have an angel group, but that angel group has decided to put together a VC. And I think in terms of what our audience wants to know is key differences in terms of methods and how you decide on what companies to invest as an angel or as a VC. So who wants to go first? Chris.
I'm happy to kick it off. A lot of the difference from 100,000 feet, they're very, very similar, right? Risk equity. You're doing a deal structure where you're taking part ownership in a business on a full assumption of risk basis, with the idea in mind that if there's any upside, you'll share it, right? So for many people, they're really very, very similar. But there are some very important differences that drive real impact on entrepreneurs, and many of them are structural. Angels are individual people investing their own money, and venture capitalists are money managers investing other people's money. And they're doing it under a fund structure that has a timeline. They've made commitments and set expectations with their funders, their LPs, around when they're going to return that capital and what kinds of returns. And as a result, they tend to operate on a thesis according to a charter, and they tend to be, if you were to draw a little distinction, and the angels who are joining me on this panel will cringe a little bit, but when I say this, but the reality is that VCs are probably a little heavier on financial capital and a little lighter on human capital. And angels, in comparison, are a little heavier on human capital, a little lighter on financial capital if they don't have a really big fund behind them. And they tend to be have lots of advice and people and so forth. So angels and VCs are really not competitors. They're very complementary to each other, and they typically stack up. There is quite a bit of overlap, but they tend to stack up sequentially. Angels tend to go in a little earlier, and VCs tend to provide a little bit more of the growth capital. There are seed-oriented VCs and micro VCs that play in the very early stages, but if you were to generalize, you would say that. One of the really, really critical distinctions that I think our entrepreneurs should appreciate is that, and this is I'm really being tongue-in-cheek here and a little bit, I'm being a little bit loose, but angels and VCs are really solving different problems. Angels are really solving the problem of, I wonder how far we could get this company on a couple of bucks. And VCs are solving the problem of, what the hell am I going to do with all this money? I got to put this money to work somewhere. And when you are running a big VC fund, let's say you have $1 billion fund you have to put to work, top quartile returns in your industry is only a 2x. Top decile returns is a 3x. You think, well, that's not too bad. But on the other hand, if I said to you, hey, Juliana, I need you to come up with $2 billion in profits in 10 years, you'd be pretty hard pressed to do it. And one of the tools you have is $1 million in seed capital, $1 billion in seed capital to do it. But you have a limited team. You might only have 5 or 8 investing principals, and you have to put that money to work in a manageable number of deals. And so the reality is, you know, there's only, being on a startup board is extremely labor intensive, and there's only so many boards you can sit on. And if you have $1 billion to put to work and you've got 5 or 8 investing partners, you can't do 200 deals and properly supervise them and meet your fiduciary duties to your LPs. So you're going to have to do a manageable number of deals, which means you're going to have to jam a fair amount of money into a manageable number of companies. And so VCs, as a general matter, if I were to create a stereotype, you know, they tend to focus on opportunities that are a little bit more capital intensive, and their model really requires them to put a little bit more money into a company, which has a cascading effect in terms of expectations for the size of the return, the size of the market, and so forth. Whereas angels can make money on smaller exits with more lightly capitalized companies. So that's about 1,000 tropes and stereotypes in a one answer. I'm going to defer to the smarter folks on the panel, but that kind of gets the ball rolling, I think.
Thanks.
Yes. So I'll jump in after Christopher, because I've kind of crossed the bridge, right? So I've gone from being a very active angel to now managing a fund, and it is different, right? Because when I was an angel, I could choose to make, I was one person, right? It was whether I wanted to invest in a company or not. When you're part of a fund and a fund management team, there's an investment committee, right? And so in our case, you know, my partner, I've got a partner, and we have an analyst. We have to both agree. That's how our docs, you know, it depends on how your docs are set up, but we have to both agree on the company. So that's another hurdle you have to follow through. It's also what Christopher says, is you're looking at your size of your fund and what the return is. And that's something that as founders, they should look at. That information's available. It's usually out there, and how big a fund is. And to Christopher's point, you're trying to figure out how you drive return on your fund. We still have a portfolio construction theory for the fund. We're a small fund. We're considered a micro VC. Our economics are probably more like angel deals than, say, you know, these mega funds, as we call them, or these Uber funds that are $300 million plus. They really need to be looking for unicorns to drive their returns. As a small micro fund, we don't have that. We can still do it. We can still do some niche plays. That being said, we do still like being capital light. For our size fund, that makes sense. We can't, you know, we have the same, we know how many companies we expect to do well and how many don't. But we have to be a bit more strict about that capital allocation model. I think something different to think about with VCs versus angels as well. I disagree with Christopher on the EQ, financial quotient, but maybe that's because I was an angel coming into the financial side. But there is something about trying to get to profitability of companies and which ones do you continue to fund. And VCs plan for that. There are some angels out there, I'm not one of them, who say, I write one check, right? VCs can't go in with that mindset. You have to know that you have to be able to follow on with companies. They're going to hit some hiccups. It's been a big part of this funding environment right now with the PPP and the federal funding was, can the VC, are VC-backed companies even able to be eligible? And so, VCs go in knowing for every dollar I'm putting in, I'm reserving a certain number of dollars behind that company. I may choose to pare down which companies I follow on, but that's an important part of it. And it's an important element to understand because we have dry powder right now. Some angels are pulling back, and again, I'm not trying to slam either side of the market, but it's, you've got to really take a long view in this versus, I just got hit from the stock market. We still have to be investing, right, and finding companies to invest. I have to say, from our angel side, we actually, our quarter this year, we funded the same amount we funded in 2019. So our angels are still investing. And I think that's something we'll probably talk about later, but people are still in this market, understand the risks, and continue to do that dollar cost averaging you need to do to make sure you have returns in the market. So I'll stop there.
Thanks, Deb. Ziad.
Yes, so I agree with both Christopher and Deb. So I'll try to add my own flavor to the mix. So the whole VC versus angel, obviously, the first angle is certain discipline. So as an angel, I would go back home. I made a deal with my wife that we would do 2 votes to make a deal, and then I would only invest 3 deals per year. And then I would make the investment, and then I come back and I'd say, but this one is amazing. Can we do one more? And then maybe, I don't know, cancel a vacation. But everybody is investing. So FOMO kicks in. And so there was really zero discipline in my approach. The VC approach, you have to stick with your initial commitment to your LPs that we're going to invest in these industries or this type or this size, so there's more discipline from the VC angle. The old school approach was that a VC will take 51%, so they would put in a lot of money, take a big chunk, take control. There's a new brand of VCs that are they do follow-on rounds, so there's this middle ground of players that are small, let's call them VCs plus family offices. So the landscape changed a little bit, and people love when angels lead and then VCs follow. That seems to be a model that's VCs and family offices. Also, an interesting anecdote, I was talking to a VC who has, let's call it 100 million fund, and we were going over their portfolio. Not once they mentioned the founder, not a single time. Their whole list was, this company is in space and this one is in this, and they have amazing IP. If I were to go through my portfolio, it's all about founders. This founder did this founder did that, this is what they're doing. So there's, and I try to understand what, Christopher, you were mentioning about human capital and financial capital, and I understood it as you mentioned it, the whole people versus money, and VCs are still plagued in that whole money piece, and they're tough. They will crush angels. So I was taught to worry about VCs. I was taught to always worry, to make sure we have some control. So if a VC come, they don't take preferences and all kinds of things, where angels took all the early risk and VCs take all the later reward. And that the last money calls all the shots. And now with Corona, we're going to see it right and left, where whoever has money now can tweak deals to benefit them. And I've seen deals where I was in a deal that had an exit, and I made more money than the previous 2 rounds. I had no idea. I just invested because I liked the deal. And that's where the technocrats among us really understand these games and understand when to invest and how, and notes versus equity, and when, and board control and liquidation preferences. So those come into play when you see that whole interaction between VCs and angels. And so I
Yeah,
leave it at
that's
that.
a very
And
good
we don't like
point,
VCs.
the the fact that PEs like funds that, like companies that have been funded by angels first and then VCs, but a lot of the angels, at least at the ACA, are a little wary about VCs coming after. And I heard from a lot of ACA members that they would rather invest in deals that are not going to be backed by VCs later on, or they would rather bypass VCs altogether. And the ACA has been great at putting syndications together up to 10 million. So totally bypassing the VC round. So, Chris,
Juliana, I don't know. I don't know. I'll try to make this relevant to our audience, our entrepreneurs. But we had a lot of exits last year, and of our 8 biggest exits, 7 did not have VC and paid off very well for the founders. The problem with taking a big slug of capital is that you need to pay a big slug of capital back, which means you need to grow very quickly into a very large market to deliver the expected returns. And there's a funny quote, I forget which founder it was, but they were talking about how they've never understood this idea of being congratulated on raising a big VC round. He said, to my way of thinking, that's like congratulating someone on taking a big mortgage. And you can think about money you take from angels or VCs as a loan the buyer of your company is meant to pay back, right? And so the more money you take, the faster you can grow. But the flip side is you're lighting the fuse to a bomb, and you bet if you're going to make that commitment to your investors.
So to that end, you know, many of the Greentown Lab companies are hardware companies. So they're not going to go the typical IPR route. So what do you recommend for them? Should they follow the angel route? Should they follow the VC route? And I know that many of you do both. So what would be the recommendations for them?
I'll start with that. I don't know that one size fits all, right? Because I think it depends on the market you're going into. If you're a true kind of B2B, you know, sometimes you need that capital to be able to grow your supply chain or your distribution channels quickly. I can think of, I'm in a bunch of hardware software plays or hardware plays. And it really depends on how fast you think you can get to market and how much capital you need before you hit profitability. And I think it's understanding who are the right players in it, who are the right funders for you to be working with. I mean, not all capital is the same, and not all funders are the same, whether it's angels or venture capital. I think it's how do you think that you want to stagger that? So I'll give us some examples. I tend to invest in companies. Again, we're fairly sector agnostic. So angels can be really good in micro VC for the early stages and kind of getting some of the early milestones checked off. And then you might want to bring in a very specialized venture capital firm later who really knows that market and knows the players and can help you drive and scale quickly. And we've seen good success with that. So I think it really depends on your company and understanding. And sometimes corporate money is good, like strategic corporate VC. Sometimes it's not, because you could potentially block a potential customer if they see them as an investor in you. So there's a whole bunch of things as a founder you have to weigh. And I think what's important to get across right now with this group is think through that, right? So don't just be thinking about your current round. Think about what does the next round look like, and even the one after that. If you really have to grow quickly, where is that potentially gonna come from? And you want to have the right things in place. You want to have the right things in place that those next financing's easy.
One observation I'd make, Juliana, about hardware is when you think about those plans, they are as business plans, they have less room for error in them. There's a supply chain. It's harder to revise the product. The margins are a lot thinner. You're shipping atoms, not bits. So when you think about looking for the right financial partner for a hardware company, you're really looking for three attributes, right? You're looking for some decent depth of capital. You're looking for pretty good tolerance for risk, and you're looking for patience because they understand that hardware, all the aggravations of hardware are also its strengths in terms of defensibility and so forth. So um, there is no default correct financier for any particular company. It's really going to depend. But as a general matter, a lot of the angels I know tend to be fairly careful about hardware because the timelines can be long, the risk can be quite pronounced, and there isn't a lot of room for error in the business plan because the margins are so much tighter, and the need to raise money on faith is often longer than a software company that can begin to show some relief from burn just due to recurring revenue or whatever. And the capital needs to done right. Hardware can be pretty capital intensive, not always, but often. You see that in medical device, you see it in other places. So it's really about thinking about what are the attributes of the financier you need, and that's really driven by the nature of the company and the nature of the opportunity.
And to that, can you tell us, all of you, a little bit about your thesis? And I know that all of you have invested in some Greentown Labs companies, but is that part of your portfolio? How do you allocate your portfolio? And next question would be, how is your portfolio doing amidst this COVID-19 crisis?
I can start. So let's talk about the COVID-19 because I have an interesting angle to this. So what's happening is terrible. Obviously, it's a pandemic. I don't know anybody who's lived through one. So unless you've lived through the 1917 one, so it is. But a lot of us and a lot of angels have lived through the '08 crash, and then the older through the '01 boom, through the .com bust, and then for older people, and angels tend to be older, so they lived through prior. So there, it's nothing is new. I mean, drama happens, and now at this level, it's very intense. So it's terrible for restaurants, for hotels, for conferences, but for entrepreneurs, and this is, please, this is my personal opinion, for entrepreneurs, it's like, okay, well, you're being tested. So if you survive through this, then you're a true entrepreneur. A true entrepreneur. The good time entrepreneurs, I call them the good time entrepreneurs, where people think, what should I do? Get a job, go back to college, or launch a business? And I'll raise some money. These are going to naturally be let's call it, pushed out of the ecosystem, because to be a true entrepreneurship is hard. Getting to an exit is hard. Launching a business is hard. If it's easy to raise money, that doesn't mean entrepreneurship is easy. So if you really are a true entrepreneur right now, you are hustling, you're figuring things out, you're not whining, you're not complaining. And it's like in a forest, if there's a storm, there's a natural pruning effect. So you see all the dead leaves are fallen, and so it is a natural process. And other than the human toll of this pandemic and a lot of the pain on the entrepreneurship world, these are I don't want to use the word exciting times, but these are times where starting a business now is a great time, because you're at the bottom of the pit, you're at the bottom of the wave, and technically there's only up from here. I mean, I don't think we've seen anything worse than what we are now. If you survive it, then you're a true champion. One of our top entrepreneurs just closed a multi-million round. It's a follow-on round. They closed it last week. We've had some of our biggest success stories were companies who went public right after '08. We had another one that was launched in '09 went public. So an entrepreneur should not be afraid of what's happening now. And then angels, we're not a charitable fund. So we're here to help, but we're not here to cry and to whine. And this is like roll up our sleeves and help any way we can. We also should expect good deals uh, uh, um, and incentives. And these are, I mean, I've personally never been as busy as the past 4 to 5 weeks, maybe because it's online. I'm starting to schedule virtual travel time because I didn't realize how exhausting it is to be on a computer from 8 a.m. to 7 p.m. Um, and never been so excited to help entrepreneurs who really want to make a difference. So on the portfolio side, obviously this time is wreaking havoc in portfolios, and you're seeing companies struggle. Um, you're seeing companies that are thriving. There's still money out there from, definitely VCs have money. Revenue is cool again. That's a concept that before were, and then also pure entrepreneurship is cool again, where the true entrepreneur, there's money in the US, there's out of US, there is, you can go into hibernation, you have to be creative, you can't be complacent. Arrogance doesn't fly anymore. So we're back to the true values of entrepreneurship, and it's in a way refreshing. Two people with an idea with a valuation of 5 million now doesn't fly anymore, and now the times are interesting. So I leave it at that.
Deb, what are your thoughts?
Yeah, so I think there's a couple questions wrapped up in there, but I'm going to go back to Christopher's point about human capital and financial capital in terms of how portfolio companies are responding right now. You know, on the human capital, this is a huge stress test for founders, right? I mean, it's something you don't get to see, and it's happening across the board. And I think what you're seeing is founders are rising up to it. Like, this is what you would expect from, you know, from entrepreneurial founders. And I think Ziad said earlier on about, it's about, you know, there's always the jockey and the horse, but the jockeys have to shine right now. And but on the flip side of that, I'm finding a lot of my CEOs, where I'm an advisor or a board member or observer, you know, are reaching out more. Like, they need more support than they might otherwise, because they're trying to remain calm for their teams. And so they need that relief valve. And so I'm finding, you know, a lot more calls. And I've always told my CEOs, like, call me anytime. And when they call, I'll cancel, you know, I drop whatever I'm doing, right, to pick up that phone if they're calling me. So I'm seeing kind of that balance there. And this is tough for everybody, right? It's tough for their workforces, you know, just the changes going on. It is unprecedented. And I'm one of those older people. I actually also lived through the 87. I came out of college during the 87 market crisis. So I've seen my share of these. On the funding side, I mean, it's all over the map, right? We've had companies that have had term sheets pulled for follow-on rounds because of, you know, who knows why, or they, but we've also had companies that have managed to close, you know, huge rounds during this period. On the funding side, it really depends on where folks are. You know, it's been a lot. We've been finding, this is a cross between both the funding and the human capital side, but, you know, our CEOs are overwhelmed, right? They're trying to retain customers. They're trying to manage their workforce. They're also trying to potentially have to cut people because they've got to manage their cash burn. And so we've just been trying to provide a lot of resources for folks, kind of helping them filter. I mean, I don't know about anybody else, but my inbox is overwhelmed with, you know, webinars and ups and whatnot. So we're trying to really condense that down and give what we feel is most salient out to the CEOs to help them focus, because it's shifting week by week on what's going to be important. And then I'll just tie it to sector. What we're seeing is it really depends on what sector people are in, on who's doing well right now and who's not. We tend to focus on B2B with the fund, at least. The Angel Network does do consumers. We're about 50 life science, 30, a third consumer life science, and then B2B enterprise software. In the fund, we're more in those latter two of kind of digital health and B2B software and services. And it really depends on the market people are in. If you're in travel, yeah, you're getting killed right now. And you're trying to figure out how to help companies get through this period till things start reopening. If you're in some other things, like, we have some people that are getting a lot of inbound that you wouldn't have expected and are doing really well in this time. So it really is specific, and we're trying to evaluate and how do you help those have to get through it, because it will rebound, right? We all know, we will rebound, but it's how do you help each company independently, given where they are. I'll leave it there.
Juliana, Ziad and Deb did an awesome job answering that. I'm not going to try to re-answer it, but I might add one sort of incremental set of observations around investor psychology right now. Fundraising is definitely going to continue. There's lots of money that needs to get put to work, and in the case of angels and to largely the same degree VCs, the holding period, the time horizon on our investments really transcends business cycles. An 18-month recession in the eyes of an angel is going to have a holding period of 9 years is a blip, right? But that said, and also I think angels and VCs really appreciate that some of the best companies are formed in the worst times, the most tenacious. You don't see the tourist entrepreneurs who are just in it for the wrong reasons. You see the people who can't not pursue their idea, right? So investment's going to continue, and we're seeing a lot of deal flow. We're having a lot of activity. We're processing lots of companies. I agree with Ziad. I never could have imagined how staying home all day could possibly be so busy, but it's absolutely nuts right now. However, there's a lot of the investor psychology right now, and entrepreneurs sort of need to be they need to be aware of that and need to understand it and try to navigate it. One issue is everybody just feels economic uncertainty, right? So everybody's appetite for risk and speculation is just a little bit less when there's just broad anxiety out there in the world. We also have a lot of mouths to feed in terms of existing portfolio companies. And when you have a lot of capital already sunk into a company, saving everyone you can is going to be a higher priority than adding new problems to your portfolio. And so it's going to go on a little bit more slowly. It takes a little bit longer to build a consensus in a world where people are kind of a little scared and a little bit oriented on cash, and people are chasing follow-ons and dealing with follow-on and portfolio company crises as kind of their top priority. And it's harder when you can't meet the entrepreneur and you can't meet face-to-face with your partners, and the decision-making is just going to be a little bit slower. And companies are going to need to operationally sort of try to, as Ziad said, focus on that path to profitability, or at least, getting your burn down, probably trying to do more with less, understanding your milestones. Companies that might have had the luxury of being able to raise enough to fund 3 different go-to-market experiments at once are probably looking at funding 1 or, maybe 2. So there's definitely a do more with less. And then I think one of the other, it's a little bit of a delicate topic, but one of the other impacts here is that the cost of capital's gone up a little bit. Valuations are going down. There's a little bit of a reset. Ziad talked a lot about this, but there's really 2 reasons, 3 reasons for that. One is supply and demand. If there's less money chasing the assets, that's going to have a deflating effect on value. The second is that there is a much greater sort of fear of future financing risk. That's priced into every deal, and when a company has a lot of financing they're going to need to raise, and you're looking at a very uncertain economic climate, people are going to price that into a deal. And then the third is just the perception of heightened operational executional risk, that the company is going into a world where it's harder to pry wallets open on both the enterprise and the consumer side. And so that gets priced into the deal, and you say to yourself, listen, your world is going to be harder. Your cost of your go-to-market's going to be more expensive. Your cost of customer acquisition is going to be more expensive. Your prospects are less dim. I'd still like to be in your deal, but I'm not going to pay a ridiculous speculative premium to be in your deal, given what I perceive as future financing risk and executional risk. So there is a little bit going on with the investor psychology right now, and entrepreneurs need to understand that sort of to help them navigate the market.
So Chris, given that a lot is going on in this investor psychology right now, how would you recommend entrepreneurs to approach investors now? How differently should they approach them? And how do you tackle the due diligence now, considering all you said?
Yeah, I've been in a number of conversations on this topic, and it's a very interesting question because in some ways the bar is higher in terms of getting meetings because you can't sort of run into people and collide at a big event, face-to-face event where serendipitous connections are formed. But on the other hand, nobody has to get in a car and go somewhere and clear an hour and park and those things to meet. So it's in some ways it's easier to get meetings with investors. However, the power of a warm introduction has never been greater. And I always hasten when this subject comes up to add that this is not about elitism so much as it is about sorting and triage and signal to noise ratio. It's not that you need to know the right people to get in front of me at all. It's much more that if I've got 20 things I can look at, the people who showed, to Ziad's point, great EQ in finding someone who's willing to expend social capital on their behalf and take some personal credibility risk to recommend that person to me, that speaks volumes. The skills that it took to navigate to me through other people are the same damn skills it's going to take to sell to a customer. So the warm introduction in this climate is absolutely critical. And then I think the other piece of advice that really needs to be amplified right now is even in boom times, entrepreneurs can get into trouble with projecting a sense of entitlement, whether it's on valuation or other things. You know, this notion that, oh, you know, I'm raising and I want to have a meeting with you and you'd be lucky to get into my round and I'm going to be doing a ridiculous set of deal terms at a ridiculous valuation, all those kinds of things. It's always been sort of good advice that if you ask for money, you get advice, and if you ask for advice, you get money. And I think that's particularly true right now. You know, approaching an investor and saying, I'm raising a round and it's going to be great, it's going to be closed in 20 minutes, and it's going to be, you know, you look a little bit naive given the fact that millions of people have a disease and people are dying and families are being impacted. And I think unemployment was 14.7% this morning. So that not seen since the 1930s in this country. Now, hopefully that's very temporary. And as we reopen, people will get rehired. Looking like you're clueless this is not a good time to look like you're clueless and naive. So going to an investor and saying, you know, I know the fundraising climate is uncertain, so I don't know exactly what my fundraising plans are, but here's what I'm trying to do, and I'd love to get your feedback on it and your advice on some people you think it would be good for me to talk to. That is a very, it's always a good approach. It's a critical approach in this kind of climate.
Thank you. And one of the things I wanted to make sure you knew is that we're doing office hours with these amazing investors for Greentown Labs companies. So that's a great opportunity for you to get one-on-one time with these investors and figure out what your next fundraising strategy would be. So Deb, you touched a little bit.
Sorry, can I just, you know, so there are things like our group is still doing, like we do a lot of stuff virtually anyways before even COVID-19. So we had virtual office hours. We're now doing more of those, right? So there are opportunities for folks to get into our network and get those introductions. And there was something in the chat around due diligence I think it's worth addressing here, which is I think this is actually going to make a difference in terms of, like, we've always done most of our due diligence virtually. And I've heard some people say, well, I don't know if I can do that. And, you know, one of my best returning companies, I had never actually met the founding team in person. We did everything. I was an advisor first and then invested, and we'd always done things via Skype and video. And, you know, I think this sense of, you know, I've got to know and go have, you know, this, all these networking events, this could show that could really change, and it could help, I think, level the playing field in some ways for that. So it's something to be aware of. Like, you know, if people are finding this a challenging medium, then kind of wonder, like, well, how technology, you know, why, right, in terms of what they're doing. So just a slightly different perspective on that. Like, we really quickly switched to doing stuff virtually. more stuff with founders because we'd already been doing it. So it wasn't as big of a shift for us. So I'm hoping actually it'd be better for some of the underrepresented founders in this environment because more stuff is virtual and theoretically it should level the playing field there. So sorry, I cut off your question, Juliana.
I was going to ask you that question, and also it's great that you're talking about an underrepresented funders because one of the things we care a lot about is diversity. And I was wondering if you could tell us a little bit more about the lens of Golden Seeds and how you think about those issues.
Well, I mean, we look at it that, we take the gender diverse lens, and generally gender diverse teams tend to be more diverse in all factors. But we see it's an underfunded group historically, and therefore there's more opportunities for return because they do show that they get to revenue faster. There's lots of data that's starting to come out that the private markets are mirroring the public markets in that data. There's something I heard yesterday, I have to find the actual source, but saying once they get seed funding, they actually do better in terms of getting follow-on rounds. It's just hard for them to get that seed funding. And that's the market that we play in. And that's why we choose to play in that market. I think in this environment, it's going to be tougher. If you look back to the 08, I've looked back at the 08-09 data, which is as far back as I've been able to go. We've only been tracking since 04. Women and minorities were hit harder in that period, and I think we'll expect the same. And so I would encourage all investors, I know that we don't all, but just really take a look at and how that changes. I do think potentially everything being virtual may help level that. And I'll give some advice to all founders, which is, have your ducks in a row. I think Christopher sort of alluded to this, if I'm going to get this great hot deal and I kind of call it the baffle with bullshit, right? Isn't going to fly. You've got to have, tight deck, you've got to have data, you've got to have things to support because you telling a story is important, but you're going to, it's easier for people to fact check and I think have some of the time to do that because people are slowing down, they're still investing, but, I don't think people are worried at least I'm not worried about FOMO right now. I'm just been a bit on FOMO anyways, but even now I'm like, wait, I'm going to hold back here a little bit because something isn't adding up for me. So hopefully that answered the question.
Sure. I wanted to also touch on early on about sectors and how well companies are doing, depending, of course, on the sectors they are. And many of the audience here is Greentown Labs companies, and they are in a sector that's the cleantech. And there are a lot of different views on the trend that the sector is going to take. So what are your thoughts on what the trends are for these companies here?
I still think clean tech is the way to go. I mean, that's the wave of the future. I think there's going to be some bumps in the road because of the oil price situation we're in. I don't think the need for clean tech has gone away. If anything, we've seen how much industry drives, and how geared up, in the era, if you're following I lived in China for almost 4 years. When you see the data from when they shut down, how the pollution mitigated, and you're seeing it in Europe now as well. And I'm not sure as much in the US as you saw in Europe, people are seeing that we are impacting it. I mean, dolphins in Venice, or some of the things happening in Venice now with there being clear. And it doesn't take much to really move the needle on that. I mean, it does, I guess, a huge shutdown, but and I don't think that's going to die away. So it always comes back to, I'm a big investor on intrinsics and economics and models. And I continue to think through that in how you're doing it for clean tech is important. I'm in several clean tech companies and they're still doing well in this environment.
Yeah, I think it's hard to generalize. I think clean tech, the fundamentals are great. And I'm actually naively optimistic that there'll really be some change in our country and that green infrastructure might actually come to the fore in coming years. But I don't want to start that conversation, but let's just say I'm optimistic on that. But let me give an example of just how complex this is by talking about 3 specific companies really quickly. One that's hit really negatively, one that's hit positively, and then one that's exactly in the middle. So The one that's hit very poorly that's in our portfolio is a company that uses recycled cardboard and a proprietary method to turn it into insulation. It's a product that has always struggled on cost with fiberglass and the ease of installing fiberglass, and the industry is gradually changing over, but it has much, much bigger market share in renovation than it does in new construction. And in downturns, renovation is a much bigger, housing starts go way down. Renovation is a much part of the market. So that company is a green company that is very, very positively impacted by that. So there's one example that is impact. That is a company that runs the largest solar marketplace for putting buyers with installers. And they've seen a little bit of a rebound in traffic because everybody's stuck at home on their computer and they can research anything they want using their web browser. But for the most part, the fact that oil prices are so low, and the fact that consumer pocketbooks are impacted, and people time to do a big project and expend a lot of money, maybe a zero down deal, although I think those deals are terrible for consumers, good for the environment, terrible for consumers. Overall, very negative impact on their business, and it might actually get even worse because we're projecting massive state budget crunches, and so incentives and things intended to bend the curve on technology adoption at the state level, they may come under additional pressure when states have got unfunded pension and healthcare liabilities and so on. So there's an example at the other extreme. And then in the middle, just to give a company, again, to illustrate the complexity, we've got a company that is basically a financing company for green retrofits. And in some ways, it's a great time to do a retrofit because your office is empty. And if you need to tear down the ceiling to replace your rack or put insulation in, never was a better time. You're seeing that with bridge repairs, and cities have access to their potholes. I mean, like they've never had them before. In the middle of rush hour, people have line painting crews right down Main Street in every country in every city in the country right now. But on the other hand, my headquarters is empty. My office is not that high of a priority. I'm thinking about downsizing my company. I don't know when my employees are going to come back, and cash is really tight. So I'm not necessarily going to spend a lot of money on an energy saving retrofit that's got a 6-year payback. So extremely fact specific, extremely complicated, 3 companies that show how the impact is very hard to generalize.
Thanks. Ziad, do you have anything?
Yes. So it's interesting, the whole industry conversation always comes up, and I try to never think by industry. I try really, really, really hard to never think, because also of my background, I've never been a portfolio manager, I've never been in finance, and I always worry to approach any type of investment by an industry approach where I have 5 biotech companies, let me put in some IT or revenue, and I'm always pulled back to think like this, and I always push away because of my jockey approach. So I would prefer to bet on what I consider a great jockey in any industry. Well, not in industries that are sort of the red line ones, whatever, firearms, don't like that. But in a great jockey in an industry that is not the right one for my portfolio, as opposed to the right industry. So personally, it doesn't matter. And the company that Christopher referred to, I believe it's called Clean Fiber, we're investors in that company too. And it's a great industry, but also I happen to know the jockey, and he's a fantastic jockey. So so the industry for this group, for Greentown, I mean, it doesn't matter. Personally, on a personal philosophical level, I support clean tech. I'm very impressed by the net zero claim that Christopher has been net zero for 10 years. I'm way behind, and I would love to get to net zero. Our place in Vermont is green on many other levels, and that's a personal philosophy. And it's if you're in clean tech, it doesn't really matter. You have to understand the game of raising money, the ingredients. I always try to squeeze in a food analogy into investing. Know the ingredients. If you put the onions at the end, nothing will happen. I spent a month literally doing a chocolate souffle practically every evening. My kids were sick of chocolate souffles because I wanted to master chocolate souffle and understand the 3 or 4 ingredients. So my advice to entrepreneurs, forget about your industry, try to understand the landscape, spend a lot of time. Instead of trying to pitch, be a guest at a pitch competition. Watch people. I call it also entrepreneurship empathy. Be empathetic to investors, because everybody thinks that investors, oh, you're rich, you can't complain. Yes, but we're swamped. We're miserable in terms of the load. Sometimes you finish the day like, I can't handle another email that says, hey, can we chat? Or can I have 10 minutes of your time? And so if you truly are empathetic and understand, you'll do so much better with entrepreneurs if you really know them, understand their group, their affinities, their investment thesis, what type of investors they are, and transfers when you talk to them. So you're not one of those hundreds of emails that I mean, if people understand how many emails we get a day that says great investment opportunity, and which ones we open, which ones we don't, and try to. And I say, you know what? If you understand each entrepreneur, study their LinkedIn profile, study everything. When you approach them, it's a human relationship. If it takes you don't get married. I mean, some people do. It doesn't matter, but you don't get married within a week of meeting someone. It takes a long time, and investment is as difficult or as complicated as marriage, because you're stuck with that entrepreneur for years. And so take your time, understand things, understand. I tell people, do a lot of introspection on yourself. Also, who are you? What type of entrepreneur you are? Persistence. And then also, I'll say that last comment, I call it, I stole that from somebody else. So, but it's called reverse engineer from the exit. So study your story from the exit back to show the entrepreneur that you understand how to make them money. I mean, we're all really nice people, but at the end of the day, we need money back to put it back into the system to do more investment. So if you can't prove that you can make money back, then you won't resonate, because no one wants to invest in a very successful business that never makes money back to investors. And so if you take all these and put them in a big pot, and now you can cook a great meal, as opposed to the wrong ingredients at the wrong time, and you really spend time with every ingredient, and the ingredients are the stakeholders, the investors, your customers, your vendors, your partners, your cap table, all these pieces. And as an entrepreneur, if you don't know what a cap table is, then you need a mentor. You don't need an investor. If you don't know the difference between a note and an equity round, you need a mentor or maybe an advisor. You don't need an investor. You have to know these things, and then you will become like ready or right for that close.
Thanks, Ziad. Really, this is a long-term relationship, and entrepreneurs should also do their due diligence on the investors, get to figure out what makes them tick, and also try to get them to know them at a personal level, because the EQ side of things really matters, and now more than ever. So Matt here in the chat, he's building on your jockey comment you made, and he said, like, can we emphasize betting on the jockey over betting on a pre-market business model?
What's a pre-market business model?
Matt, can you clarify the question? I'm guessing that many people are now making sure that the business model fits, even if, you know, they believe in the team.
Yeah,
Yeah,
I mean,
so
I think, oh,
go ahead.
yeah, I mean, I think both are always important, right? You know, in terms of angel and early stage investing. I think in terms of if you're trying to figure out, you know, how to show that you're a good jockey, things like advisors, referrals, people that, you know, either you have on your advisory team or you've brought around you on your team already are good indicators that you're a good jockey. I think also if you have customer, either, you know, if you're saying you're pre-revenue, so you may not have customers yet, but we love, if you have any revenue at all, we love to talk to customers, right? And having those people lined up that we can be speaking to. But if not, then it really is the advisor group and those who worked with you that we can talk to get to understand, you know, both your strengths and weaknesses. And we want people who are willing to talk about both. We realize nobody's perfect, right? So we don't want to just hear all glowing. We want to know, you know, okay, so under stress, how does this person react? Or, you know, I always joke sometimes that I try and build in something like that into the due diligence process to see how do they handle conflict or how do they handle stressful situations. Again, we're in permanent crisis. That's not appropriate now, but you know, everyone can seem to do well during an upturn, but how are people handling, you know, this type of thing? So that's just one thing on getting the jockey over the model.
So Matt is clarifying what he meant by pre-market business model. He mentioned that he thinks that most angels are not interested in investing without revenue. What do you think about that?
We're all, I can safely say we've all invested in deals that don't have revenue, and that's probably inaccurate. Like angels, and I tell people, and I said that 4 years ago, and now it's back in, it's trendy. I always say, remember the first word, it's angel investing. It's not seed investing, it's not venture investing, it's angel investing. So the angel is someone who comes and helps you at a time where you need help from someone who's willing to take a risk, who buys into some crazy idea. The world of angel investing has changed. Now and thanks to people like Christopher, ACA. I should do my part at ACA, by the way, but that's a discussion for another day. But ACA, like, it's turned the angel community into this highly sophisticated industry that rivals the venture world. But we're willing to take bets on people, on random ideas. I mean, we have one of our greatest story is a gentleman named David Friend, who decided how it would be a great idea to save your documents online instead of on a separate hard drive or on tape. Back then, people thought, oh, you're crazy. Who's going to save or archive your documents online? And then he went in, and his company is called Carbonite, and became like a $500 million business plus by this visionary beyond your times. And these are the ultimate things. Someone who says, okay, I'm going to cure cancer, I'm going to do these big transformative bets that angel invest in.
So
yeah.
I think a little bit on to Matt's point is, you know, it's always hard to get investors pre-revenue, right? You know, that's part of this industry. But I do think there's something here about showing there's a true customer need for what you're doing. You know, I think Christopher said, you know, everyone said we're still looking at deals and we're looking at things that are pre-revenue, and it comes back to what's the plan that's in place? How is the money going to be used? So we're looking very closely at milestones. Like, you know, I think it goes back to that, what's the data behind it? So you may not have customers yet, but what's your plan to get to customers? You know, what is this couple of $100,000 going to help you accomplish to either prove or disprove that you can get to revenue. And so I think it's about having the plan versus just betting on a person, at least for me.
Yeah. Juliana, this is a big enough topic and a perennial enough issue that I think it's worth piling on a third voice here. One of the issues is what you're really saying, and that someone said chicken and egg in the someone said chicken and egg in the chat, but what you're really talking about to some extent is can you raise money from generalists? Because when I'm asked what the difference between an angel and a seed investor is, or whatever, you know, why are some people willing to go in early and other people aren't, and why will this person go in early here but they didn't go in early there? When you look at really, really early pre-revenue kinds of things where it's kind of a hypothesis, the product's not finished, or there's really no sense of the go-to-market, most of the people who invest in those situations, if you actually look at it and you deconstruct it, they have one type of affiliation or another. Either they know the founding team really well, they've made money with them before, they used to work with them, or that market is their life's work. They know that market incredibly well. They spent their whole career in that market. They really know what they're talking about. Or they're really knowledgeable about the technology or the product, or they're fascinated by that idea. And those are usually the people who are willing to go in for sort of very personal motivation reasons quite a bit earlier. And a generalist who's got a lot of deals on their plate is generally, they're not going to be willing to go. And part of going from your friends and family to your seed to your angel round is about de-risking the business a little bit, getting better at pitching and understanding, finding your entrepreneurial voice a little bit, but also getting story de-risked and organized and told well enough that you can begin to access and appeal to generalist investors who don't have that affinity to what you're doing.
Great point about journalists and non-journalists, and it's true that normally non-journalists will tend to go early because they have a pulse in the market and how to make the deal happen. So I have, I think Matt is killing it in terms of Q&A. He also had a question that Deb wanted to answer about the fact that the differences between public and private markets right now.
Yes, I think so. The question was, you know, does the public market sell off mean there's more cash to come into the private markets? Not, and it's really not necessarily, right? Because you have to look at it that most, especially early stage investors or angels, are looking at maybe a percentage of their portfolio they're willing to put at play in the angel market. And so they've taken a hit on their public market portfolio. So they may have a little bit less that they're willing to put into they're probably still willing to invest, but less that they're willing to put in. So it doesn't mean it kind of came off the table from public and is going to go into private because of all the allocations. It's also going to affect VC and private equity down the line because a lot of their money comes from institutional and they have allocations of what they can be doing of public to private. And if their public markets portfolios taking a hit, it's going to affect how they have to reallocate in the private market portfolio. So it's, it's a bit of a mixed bag there. I don't know, Christopher, Ziad, if you guys have different viewpoints, but.
Sure. So
sorry, go ahead, Ziad.
No, I'm trying to understand the question is between private and public. So I would add one new thing that I'm seeing, and I don't know if this is relevant to the question, but I'll say it anyway. So later stage deals now are starting to touch public market deals. So if you have a lot of opportunities in the public sector, right? So shares are going down, and you see that you can have some returns that are so attractive that you start thinking, okay, well, I prefer to invest in some public market opportunity instead of some private deal where my money is stuck and there's no liquidity. So I've seen that a couple of times where so the angel stuff remains the same because it's early and you really want those big returns. But as deals evolve, you start thinking, okay, well, I've seen some stocks that went up, I don't know, 50% in the past 3 weeks. And people might think, okay, well, instead of investing in this B round in this company, I prefer to go to the public markets. So there is some tension at that level. But I personally think that we haven't, as an industry, digested the impact of everything that's happening on valuations, on anything, on maybe also on exits, on potential IPOs later this year or next year. So the verdict is still out all around.
Chris, anything else to add?
It's a complex world. A lot of the allocations in PE, venture, angel were already pre-existing, and people tend to think of them in different pots. At the margin, if there is really good opportunity, if the stock market really bottoms out, there's really good opportunity perceived there. A marginal dollar that an angel might have up for grabs might be invested in the stock market instead of in angel investing, to Ziad's point, just because of the liquidity advantages. But for the most part, angels are not investing the grocery money or the rent money. They're investing a small allocation of their portfolio that's set aside for long-term, high-risk, high alpha, things. And a lot of the money that's committed to PE funds is already committed. I do think there's a little squishiness in the middle of the market at the VC stage, and it depends a lot on the particular fund. But I have heard a number of anecdotal stories about LPs asking for capital calls to be delayed, fundraisings being put on hold for a little while. So I do think there's the types of investors in the VC layer, family offices are going to be a little more oriented towards cash. There is a little bit of squishiness, I think, at the middle of the market. I don't know that I don't want to exaggerate, because every asset class loves to slag on other asset classes. So I don't know that it's acute, but I think it's a little, I think it's a little bit of an issue in the VC layer.
Thank you. So we have another question from Harsh in the chat. It's related to his own company and grant funding. So his company is in the hardware infrastructure space. They have a potential cold storage solution, and they have successfully completed a pilot. And they want to know what would be the best ways to raise money to build this initial system, and if we thought that grant funding could hold a place in such technology. How do you see grant funding in, fitting in with the VC and angel models?
Non-dilutive funding.
Angels and VCs love grants. It's non-dilutive. We love it. It's fantastic. However, grants they've got to be on point. There's a lot of work associated with getting them. And sometimes they can distort your map, and keep in mind that they're pretty restricted funds. They really can only be used to further the purpose of the grant. And so they're not free money. They're non-dilutive funding. And when there's a grant that's right in your wheelhouse, that falls relatively easy to hand, I would strongly encourage you to go pursue it. But if it's not right in your wheelhouse, it doesn't fall easily to hand, and you need to spend the next year not talking to investors and not talking to customers, then I would not recommend that you pursue that grant.
Yeah, I agree. We love non-dilutive funding, but people have to be careful. And it's not a true sign of success. We have a company, they've received so far from various organizations close to, I forget, 50 million in non-dilutive money. That's huge. Does that mean they're going to exit next year? I'm not sure, because the government wants to build something that fits their model and what they need for national security. So do acquirers really care about that? I'm not sure.
Okay, so we're almost ending this panel, and if there are not more questions, feel free to put them on the chat. But I wanted to have some closing remarks from all of you, directed mainly at the Greentown Labs entrepreneurs, and also considering that Some of them are actually international companies who came to Boston, and how this is affecting, there's Deb is mentioning that now we're doing more things virtually, but also there's a sense that things are becoming more local, supply chain is becoming more local. So how is this all affecting international companies? What are your thoughts and some parting remarks?
I think there is going to be a little bit of opportunity associated with re-onshoring. Every time there's a supply chain shock, people say, "Oh, we're going to re-onshore everything," and then we don't. It's going to depend a lot on the industry. For example, when there was the flooding and the hard drive shortage, we weren't going to build chip or hard drive fabs in the U.S. They were there for a reason, but I think we got badly burned and learned a lesson about masks and PPE and things that can relatively quickly and inexpensively get re-onshored are going to be, and we will see some supply chain changes. I also think we're going to see it's a bigger topic than I think the scope of this discussion allows, but I think we are going to see some permanent changes in consumer behavior, how the workplace works, how people interact, and it's going to all be made quite a bit more cloudy by the fact that we're going from a global pandemic to a massive recession. And so there's a lot of things that are a jump ball coming out of that. But I think, you don't have to be a genius to think the world is going to be a really noticeably different place 18 months.
I can.
Go ahead, Ziad.
Okay. So I think everything's going to get harder. And on the international side, you might see also raise money locally on one side, but also crowdfunding and virtual funding also will pick up, because a good company is a good company is a good company, wherever it is. But governance issues will fall into play. Entrepreneurship has never been easy. It's going to get harder, and you're not going to find any sympathy here, because no one asked anybody to be an entrepreneur. I mean, this is an endeavor that you wake up one day and say, "I'm going to launch a business." The angel community has been amazing in the past month. We've helped, and there has been an effort all around to make ourselves available. I don't turn down any panel discussion, any speaking engagement to help. Angels among themselves are helping. It's been really a great industry and ecosystem to be in all around. And then I'll tell entrepreneurs, look, it's not easy. So you have to be creative. You have to be. I happen to have grown up during a civil war. You don't have to go through that, but I mean, a pandemic, a civil war, what's worse? And you have to be creative. You have to survive. It's a survival, and if you can't, then you're not cut out to do it. So figure out a way. Be creative. Sit back and say, what should I do? And then there is a portion of luck. If you're lucky, we have a company there in the what's called the hypochloric acid. It's a disinfectant, right? It's a disinfectant that you can spray on your eyes, on open wounds, and now they're one of the hottest tickets around, and they can't sell enough, they can't make enough. But their problem is finding empty bottles, because the bottles are made in China. So here we have a fantastic company, but the problem is, I mean, it's quite fascinating what's happening, and we have to rally. Also, the relationship between investors and entrepreneurs. Entrepreneurs who have fantastic relationship with investors, who are likable, who are trustworthy, who have really been good, the investors will stick with them. And the ones who've been jerks now will be put at the bottom of the pile naturally. I mean, that is fact. And that's what I tell people: keep a good conversation. Don't reach out when it's time to raise money and forget about investors during all this time. Be nice. Treat people nicely, because then during tough times, that's when you need them. So it's a very interesting relationship. And good luck to all. I mean, it's tough. It's tough out there.
A big shout out to Raise Green, which is one of our Greentown Labs member companies, a crowdfunding investment platform. So there's another opportunity there. Deb, I know that you have some final words of advice.
Yeah, so I think something, think about the Greentown Labs companies, right? And there's a couple things that hit me. One is a lot of them are really, they're tough. These are tough businesses that you're going into because they're tough businesses. And there's usually a lot of intellectual property that's been developed around them. And I would be thinking about how to capitalize that, right? And it goes back to a bit of Christopher's comment about, there's a lot of reshoring, but I think of it more as localizing the supply chains. So if I'm selling into Asia, I need an Asian supply chain, right? If I'm selling in the US, I need a North American supply chain. And so I see companies really thinking through that quite a bit right now, but also taking this time, what I'm seeing is portfolio companies with a lot of IP, of thinking about going back and thinking about their patent protection and what could they be doing to beef that up if they're not able to be building or in their labs right now, because not everybody is able to get into their labs or their facilities, depending on what they're classified as. So I'm seeing folks kind of taking this time and retrenching in it. And I don't know that we know what it's going to look like, other than potentially a lot less travel and more social distancing for the next 12 months. But good businesses are good businesses, and I think in the clean tech space, again, they're going to be needed. And so just maybe a different perspective on that question. But these are IP driven, and doing what you can to be protecting that and driving, really building that moat around your business is really important at this time.
Thanks, Deb. So all these great panelists are going to be available for office hours for Greentown Lab companies. Deb has also mentioned that there's office hours for the Golden Seeds. So feel free, if you have any kind of resources that you think that are going to be beneficial to our companies, put them in the chat, or otherwise Andrew's going to take notes and is going to make sure that the recording of this panel is also going to have a lot of sources for entrepreneurs. So if you have any more resources, we will be gladly taking them. And thank you so much. I can see that we have here Andrew's email at goldenseeds.com under entrepreneur resources for the various dates that Deb and her team are going to be available. Big shout out to the ACA. We have, as you can see, great members. I'm so proud to be part of the board. We're having our big summit next week, and that's going to be the first ever virtual summit that is going to be put together by the ACA. And one of the Greentown Labs companies, Spirit, is taking the opportunity to be part of the Innovation Showcase and has been mentored, and is going to be continued to be mentored by some great ACA members. So there's still a lot of opportunities to connect there. There's still a lot of opportunities, and as you can see, many great angels are eager to help as mentors. And if that relationship develops, who knows, maybe they can become your investors. So with that, I'll pass it to Andrew. Thanks a lot, everybody, for your time, and have a great rest of the week.
And I don't think I have very much to add to Juliana's awesome wrap up and the great contributions of our panelists who've graciously joined today. So I encourage everyone who's on the line today, who's interested in learning more about our investors or getting more connected to anyone you heard today or anyone in our broader network, feel free to shoot me an email. Look forward to hearing from you. Happy Friday and enjoy the weekend.
Thank you. Bye.